Samir, hi, good morning. Good to have you on the show. Samir, so much is happening in the world, and pretty much for the last 2-3 years, something or the other keeps happening. Do you keep the noise out? Because this time, the repercussions for crude oil markets have been quite steep. I mean, a 12% uptick coming in just the last week alone. Do you cut the noise, or do you get into wait and watch mode?
So wait and watch would mean cutting the noise because you don't know what's next. But in general, because of recent experience of 2 or 3 wars that we have seen in recent years, the markets seem to be not bothered. So the natural reaction again, and this time we are also doing the same, is to say, let's just wait. Because in terms of time duration, it doesn't look like it's going to be a long war. Even Israel says we are going to do it for 2 weeks. Iran has only a few X number of missiles. So if you use 200 per day, you'll finish them in 10 days. And so far, Iran is at least not trying to get US into the picture, which means they are not doing anything on the Hormuz Straits to stop flow of oil around that, or to attack the US, troops in different Middle East countries. So if it is in that sense, if it's a 5-10 day affair, even if oil is up 10%, then in a few days it'll be down 10% or 8% or whatever, and therefore no point bothering. So cut the noise means wait and watch.
All right, so that's the take on the oil. Hi, Samir. Morning. This is Shrishti also joining in. Good to see you in the new look.
This is, I have to compete with Mr. Irani's specs.
Yes.
So I said, okay, I'm going to get the same brand, which I was able to get hold of.
But a different color, and we were just chatting about
actually,
that, Samir, in the studios.
When I went, but I refused to buy the same exact combo.
But I must say, you are giving a tough competition to Mr. Irani. And we'll definitely try to get both of you on the show. But indeed, no company within this particular space is listed. So no deep dive discussions. But back to the markets. Samir, what's new in the markets? Because there's a lot of sector churning that is at play. There was a bit of a respite back when we had that RBI policy, a bit of a jump up. But how are you looking at the markets right now? Because with this global uncertainty, indeed, the Indian markets are also selling off.
So I have become very bullish, not just bullish, very bullish. And the main reason for that is that it is very, very clear in black and white that the world's allocation to US stocks is coming down. The US equity markets absorbed 65-70% of the world equity flows. If we just go simply by MSCI World Index, in which US weightage became the highest ever. And in, say, 2008-10 type period, it was in the 50s. Now it is about 67-68%. And it is clear from hearing, reading, and even our own fund that we don't feel like putting back 70% in US. So if for our own global fund, we had 74-75% in US till, say, Jan end. And now, of course, it's very less, but our goal is to have 50% in US. And I can read and see many, many articles. You can also see flows into ex-US ETFs that those funds have started picking up and getting 2 billion a week or something, which they used to get zero money before or very little. And so if that trend works, that the world does not like the US. I'm currently reading Ray Dalio's book saying that the US is going to have a heart attack in 3 years in terms of their dollar and US debt and all that. So all these things are leading to the fact, and also because of political issues and other issues, that the world does not want to get back to a 67% weight. And slowly, if that happens, and it is already happening, then the 33%, 35% of the audience, which is the 100 minus 65, if they get 5% from the 65, 68, which US has, that is big flow for everybody. In our case, anyway, we are also getting some flow. We means market. And initially, we don't need to get massive flows. We first need to stop outflows, which were happening for the last, since October. So if the FII stops selling and then buying a little, and Indians are buying, the market can stop falling, and you can see it look at it with optimism. I don't think market will go up a lot, but if you and everybody believes that the market will not fall a lot or may not fall or may go up 5-10%, then that is enough for the fund managers to seek mid cap stocks and small cap stocks once you are a little bit comfortable with the backdrop of the market. And of course, then the interest rate cut and the fact that our growth is better and all those other things will come. But it does not mean a big rally, but it is. It can be viewed with optimism.
Okay, point taken, Samir. Hi, morning. Also share with us your view on China, because you believe that China is an economy that cannot be ignored. We've got very strong retail sales numbers that have just come in this morning, highest ever since December of 2023. Their May manufacturing numbers, even though contraction persists, there's been a slight improvement on that front as well. Given all of this, the tariff overhang is still there, although Donald Trump claims that they have come to some sort of truce on that front. What are you making of the Chinese economy?
China is very good. As an investment, it's very good. We used to have 4-5% in China when we had 75% in US. Now our China goal is to have 15%, 15, and we are at some 12-odd%. It's the IT stocks, the tech, not IT, the tech stocks there are very good. The auto stock is very good. They have a similar to Spotify, Tencent Music. They have similar to our Make My Trip, the Parent C Trip, very good. All these are absolutely great companies. And it's a cycle, and China is very cheap. It has to be bought or should be bought, and people are buying also.
Right. Interesting you say that. Samir, let's talk about India specifically. Yes, there have been all the positives that have come about from the RBI bazooka. Interest rates are controllable. Your EMIs are coming down. Inflation has cooled off. All of that is there. But there is the other part in the market. I was just looking at the data coming in from IPOs that pretty much 40% of them are below their issue price. And these blocks that are happening in the market, I mean, one is wondering, is that sort of a warning signal at all? How do you read into that?
So actually, when some IPO is coming, I actually push the idea that it should come at twice that valuation that which it is coming at, which anyway is an obscene valuation. And my job is to encourage them to come at an even higher valuation, because by staying away from these, anyway, you add a lot of value and we are all being compared to each other. So I think some of it is absolutely overdone, and good luck to the guys buying it, but let them buy it even higher prices for all we care. In general, this is just joking, but in a serious way, the thing is that it is a chicken and egg, which means the flow does not come, the selling does not come first. The fact that the market has ability to buy comes first, and then the private equity guy remembers that he has stock to sell, and promoter says he would like to buy a house. So this is sort of an automatic adjustment. It's not that, oh my God, the market has 10-20 billion to sell. How will people get so much money? No, when people have money, then these stocks will come for selling. So it's a self-correcting mechanism, I would say. But in general, if you see the percentage of money that is spent or invested in these IPOs and blocks, it is still not very, very obscene. Our market has become very big. It's now like $5 trillion market. So you can have these and still market can move on. But in any case, there is no logic for the market to go up a lot, which means like 20%, 25%. So we are also expecting it to go up 10, 12%, 15% over a year. And therefore, maybe this is one of the reasons that it won't go up more. And also it should not go up more because the earnings growth is not that great. But only thing is, if it stops falling and a little bit going up and the trajectory is a little up and there is some confidence in improvement in numbers later on, then it just makes the fund managers more willing to go out on the curve and look for stocks which otherwise they would not look if the feeling was that the market is just falling and going to go down a lot. So that optimism is all I need to be excited in looking at new companies, meeting new managements, knowing that the backdrop is okay, or better than okay.
Are you wearing those glasses to meet the new managements is the question though, Samir.
Sorry, what?
I said, are you you wearing those shades that you're wearing right now to meet the new managements? Is the question.
When I go to raise money, I don't wear these specs. When people come to me to raise money, I can wear what I want.
Absolutely. But, to the point that you were making, I mean, I'm just wondering whether it's time now to look at those bottom-up stories. I mean, is that where tactically alpha generation would happen?
Absolutely.
IT already has given you good returns in the last 3 months. Is that the space that you need to hunt now?
So they basically you have to do bottom up only because the backdrop is not so strong that just by being invested you will make a lot of money. You will do okay with that also. But as I said, if you are comfortable with the overall market in the sense that it is holding up and that there are flows and there is interest and there are interest rate cuts and there is some economic recovery and the GDP growth was good and all that, but still you know at the back of the mind that this is not immediately leading to 15-18% earnings growth, then you look for companies that have 14-15% or more earnings growth, which are not very many, and that is the bottom up thing you're searching for. If you can find them in sectors that you are otherwise comfortable with, that these are not protected sectors or highly competitive sectors or being disrupted sectors, and so that is where the bottom up is coming.
Sector are you liking, Samir? Give us some sense there, because we know your favorites. Financials is the one pocket that you have been liking. The new age tech companies, we have talked about some of those companies as well in the past. And auto and IT were not your favorite sectors the last time we chatted. Any change there and any new areas of liking?
Well, basically, we have become comfortable with all the new age guys even more. That is, the names. So we like them and we like them a lot because also there is although today's your newspaper has a completely, I think, a 3-month-old story, but there has been a reduction in competition in the food delivery and quick commerce sector, particularly the quick commerce side. That is very black and white clear, but maybe the report is 10-15 days old or whatever. So in general, that we like the insurance selling online company, we like the logistics company, we like all these new age but otherwise effectively old economy being disrupted with new this thing rather than IT. These are not companies like a travel company with everything happens online. There you still need a lot of logistics part or a delivery part or an implementation part. Therefore, you can't call them tech, but these are whatever you call them, new age tech plus effectively implementing these things on the ground. Otherwise, we don't like IT at all. IT, I know people can say what they want. I think IT has been disrupted. By the way, everything is getting disrupted. Recently, we saw that is last week that credit cards are going to be disrupted now with Walmart and Amazon saying they might bring out stable coin. And then on Friday, Visa and MasterCard fell 5% each. So everything can be disrupted. So you might as well be on the side of the disruptor. And our Indian IT guys are being disrupted. They can align with a few disruptors, but they should have done the disrupting and they haven't done it. They can at best align with some disruptor for a few years, but they have been disrupted.
Okay, Samir, point taken. So IT is something that you're not liking right now, even though it seems like it's an emerging sector, at least in terms of how the stocks are doing. Other than that,
they are not emerging.
Okay.
They are from 90s. From 90s, these stocks are working on this basis, that linear model that you will do work for US companies. And now the AI is doing that disruption. Of course, in the beginning for 2-3 years, the Indian guys can say, and it will be true also maybe, that they will help the implementation of those things that AI can do later. Somebody will have to handhold the big companies in the US or otherwise to how to use that AI. But conceptually, I'm saying, conceptually, the projects will be to replace. Now, all these guys, not only our Indian IT guys, not their fault, but the whole world says that AI will not lead to loss in jobs and we will do even more creative things. And the world has always not, with every technology, we have not lost jobs. but nobody has called it like these guys now say AI is bigger than industrial revolution. It is bigger than this. I mean, there's some storytelling. According to me, every poor job is going to be disrupted, including fund managers' jobs, except that I've already worked for 30 years, so I don't care if my job is disrupted after a few years. But unfortunately, this is job negative for the world.
Samir, what I meant was just in the last couple of weeks, we've seen a little bit of an uptick coming in some of these IT names. But what I really wanted to ask you was, other than IT, are there any sectors that you would caution our viewers against, something that you're absolutely not liking at the moment?
So I don't like all these I don't like any of these new solar type companies, companies where 80% is being sold to government. Just understand, one of the biggest successes of India is UPI. And suddenly, out of the blue, in the last year, the government cut the subsidy that was being given to these guys by some 60-70%. They used to give some 2,000 odd crores, I think, collectively to the industry. Suddenly, out of the blue, they said, no, it is some, I don't forget, but some 500-600 crores, and thank you very much. And we are not letting you make money from the merchants. So this is what it is as of now. The thing is, where government is a big customer now, with this company going public, 80% of business comes from government, and government gives some incentive. And then 2 years later, government says no incentive and story over, or it doesn't pay on time for that. So there are many such things where you may think that it's an emerging sector, but these are commodity sectors. Even if they have emerged, who cares?
Samir, the other thing has been this entire, capital markets theme. Barring a few bad days here and there, it's been pretty much a one-way move up.
Correct.
Is there more meat to the rally? I mean, what do you do here?
So that we had many and we still have a few. But it looks to me, yes, I agree with you that it's a bit too much. I think they are rigged, whatever is the definition of rigged. Because my formula for calling a stock rigged is when in the first 30 seconds of the opening of the market, the stock is up 2-3% and many lakh shares have traded. But I don't think any investor does like that they are waiting for 929 or whatever, 914 and a half to buy a stock, even though it's been up 50% in the previous 6-9 months. According to me, that is the starting point of saying that these are rigged by somebody.
Samir, great having you on the show. Appreciate all your views today. And once again, thanks so much for joining us. On that note, we'll let you go. But let's shift focus once again to everything that's been happening between Iran and Israel. Tensions are rising and the world is staring at possible disruptions in oil supply, with Iran threatening to close the Strait of Hormuz. The narrow waterway